Hi everybody, welcome back to Hudson's Gambit. This is the opening exercise you worked with in your first night of the Business Advantage program. What I want you to do with this video is use it to help you understand how an accountant would have approached that exercise after you read your assignment for week 2 of Business Advantage program. So you need to read your assignment first. It introduces you to the concepts of debits and credits, and then pull out the exercise that we did from last week, and we're going to walk through how an accountant would work their way through all of these transactions. All right, so here we go. First thing that happened here is that you had $30,000 from your sale of stock in some company. I think it was Apple. And you invested that money into your new business. Well, what that did was it increased the assets of the business, and it increased your ownership in that business. So in journal entry 1, you're going to show an increase in assets, i.e. you've got cash of $30,000, or the business has cash of $30,000 that it didn't previously have, and you now have equity. You have an owner's capital account, which shows that that $30,000 was sourced, funded by you. All right, in your second transaction, you went to the bank and you took out a note in the amount of $75,000. Now you have to repay that, but not today. Today, when you take out the note, what happens is you increase your assets. Your business has access to $75,000 that it did not previously have, but it also increases the amount that you owe, or your liabilities. Now, for journal entry 2, you're going to have to show an increase in assets by debiting your cash account $75,000, and you're going to show an increase in liabilities because you didn't have an obligation, now you do, by crediting notes payable $75,000. In your third transaction, you visit your landlord about renting a retail space, and what you end up doing is you pay 2 months in advance and you provide a $3,000 security deposit. All right, well, one of those 2 months is actually covering the first month's rent. And what we typically do with an item like that that's being used up almost immediately is we recognize an increase in our expenses. That's our current rent. For the prepaid rent and the deposit, we're going to create some assets because those are going to get used up over time, and as of today, they still have future benefit to us. All of this, however, is going to use our cash in order to do it. So for journal entry number 3, we're going to show that $1,500 that we paid constitutes a current expense of the business. In other words, it is what is necessary to keep the business running. $1,500 of what we paid is a prepaid rent, which is an asset to us. It's something that has future benefit. Another $3,000 is also an asset called deposits. It has a future benefit to us, and in fact, we hope that we're going to get it back. Assuming we abide by all the rules. And it took our cash to complete all of these transactions. So we have to show that our cash has decreased $6,000. All right, in our next transaction, we go to the retail inventory wholesaler and we buy some products to sell. Items that we purchase in order to resell them are considered inventory, and inventory is an asset. So in buying these items in order to resell them, we are both going to increase our collection of inventory assets and decrease our cash. So journal entry number 4, we show the increase in inventory with a debit of $5,000 and a decrease in cash with a credit of $5,000. In our next item, we have to buy some shelving and display materials and so forth, and all of these items cost about $15,000. All of them are estimated to have a useful life of approximately 5 years. So these are all items that have future benefit to us, and we will be using them in our business. So again, we have a transaction that both increases our assets in the sense that it gives us new furniture and equipment, and those are assets to us, and it decreases our cash. So journal entry 5, we show the increase in furniture and equipment by debiting that account, and we show the decrease in cash by crediting that account. In our next transaction, we are going to get all of our utilities turned on, our telephone, internet, and so forth. Our cost is going to be $250 a month, all of which is payable at the end of the month. While this is a business undertaking, there's no transaction yet. No exchange has occurred. So we might make note of the contracts, but we are not going to make any journal entries. Whoops, I clicked a little too fast. So back to that one, there is no journal entry. Next thing we do is we hire an assistant, and we tell the assistant that we're going to pay them $350 a week, and they'll also have to pay payroll taxes of $50 per month. Again, this is a business undertaking, but until the assistant works, we're not going to pay them. So there has been no exchange at this point. We don't have a business transaction. There's no journal entry that we need to make. We'll keep note of this. We'll recall that this employee makes $350 a month, but we're not going to do anything here until the very, very end of the month. All right? Next transaction, we are going to pay for 1 month's advertising. We're going to hire an ad agency to help us do this, and our cost for the first month is $1,000. Now, advertising is one of those things that a lot of people like to argue that, oh, it should be an asset because it is going to provide future benefit, and it probably does, but because it is so difficult to match the benefit provided by advertising with the actual cost. So I might pay my advertising today and it may not pay off for months or ever. What we tend to do is just treat that as an expense and expense it as we incur it. So this journal entry is going to require us to recognize an increase in our expenses of $1,000 and a decrease in our cash of $1,000. All right, so it comes to the point that we're selling goods to our customers. And on our first day of business, customer number 1 comes in and buys 20 items. Customer number 2 comes in and buys 5 items. And customer number 3 comes in and buys 15 items. All right, and we've priced our inventory at twice our cost. Now, this one can be a little tricky to think about, but there's really 2 effects here. The first thing that is happening is as we sell our product, we're getting cash in and we're earning revenues. All right, revenues are the items that we're in business to, or the product of the items we're in business to sell. All right, so that's the first thing that happens. Let's see if I can bring this up. All right, so we're going to debit our cash for $8,000 and credit our sales for $8,000. That shows the increase in assets and revenues. But in order to make these sales, we had to get rid of some of our assets in the form of inventory. All right, so we have a secondary issue here, which is that, well, we lost our inventory, we gave our inventory away to the people who paid for it, and that also creates an expense of doing business. All right, the expense is recognized as something we call cost of goods sold. It is an expense account. But basically it's saying for whatever we sell, there's a cost associated with each item. So if we're selling an item for $15 and it cost us $5, we don't just recognize the $15 that came in. We must also recognize the $5 that it cost us to make that sale. So we'll debit our expenses to show that they increased, and we'll credit our inventory because those items that were sold are no longer available to be sold. Let's see, we have customer number 1 comes back and returns some items. What this is going to do is reverse both of our previous entries. Right? When we made the sale, we increased revenues and assets. Well, now that it's being returned, we're going to have to decrease revenues and assets. And when we made the sale, we increased our expenses and decreased our inventory. We have to reverse that also. So first thing we're going to do, instead of debiting the sales account, I'm going to capture my returns in a separate account called sales returns, just so I can see how many of my items are getting returned each year. It's going to function the same way. It's going to bring my sales down, but I can track separately the total amounts that I sold and the total amounts that were returned. I'm also going to credit my cash because I have to return that cash. In addition, I am going to reverse my inventory and cost of goods sold entry. That inventory is now available to be resold, and there's no expense associated with it. So we bought some more goods for sale. These goods cost us a little bit more, $15,000 to purchase 50 items, and our markup is 150%, 1.5 times. All right, in buying these goods for sale, we debit our inventory account, we credit our cash account. When we turn around and sell those items to our customers, again, we have a two-part effect. The sale is going to increase our asset, we're going to get cash, and our revenues, but it is also going to cause us to recognize that our inventory is gone and there's an expense associated with making that sale. So journal entry 10A will debit cash and credit sales for $18,000. That is made up of $11,250 for customer number 1 and $6,750 for customer number 2. Then we'll also debit our cost of goods sold and credit our inventory, whoops, sorry about that, for $12,000, which is the total cost of the items that we sold. All right, so if we stopped here, we could start to answer a lot of questions that were difficult to answer the first night of the Business Advantage program. And the way we would be able to answer them is by doing a trial balance. What that means is that I'm going to go through and I'm going to list every single account that was debited or credited. And you'll notice that they are listed in a particular order. Assets, all the way down here. One liability account, notes payable. One equity account. Then sales and sales returns, we always put those together. Cost of goods sold, and the rest of our expenses. Now, the thing about the trial balance is to get my sum for cash, I have to go back, and every time cash was debited or credited, I have to add or subtract that up. And so if I went back and did this manually, and you might check my math on a couple of these, just to make sure that you see how we're doing it, we'd find that at the end of the day, we have $88,000 in cash, $3,000 in deposits, and so forth. Now, when we get down to notes payable, we have a credit balance for notes payable of $75,000. We have a credit balance for capital, or owner's equity. Then sales were $26,000. Notice sales returns reduced that, so the net is $25,000. And then our expenses come down in here. The thing about a trial balance, it doesn't tell you that you've done everything correctly, but it does tell you one thing with certainty, and that is, at the end of the day, your debits equaled your credits. It's not everything, but it's certainly important. All right, and then from this, we could start answering some of the questions that you were asked in the first night much more easily, like how much cash do you have on hand? Well, we have $88,000. How much inventory do you have on hand in terms of value? You've got $4,500. Let's see, we also asked you, do you have any equity? You betcha you've got some equity in the business. What were your what were your net sales? $25,000. So anyway, this is just a kind of a quick and dirty explanation or example of how you put the information you found in your readings to work with Hudson's Gambit. Take a little time, make sure you understand the debits and the credits, and we will continue from there next Thursday. I'm looking forward to seeing you.